Okay, so a 6% drop in the S&P 500, I mean, that's got to have some people feeling a little uneasy, right?
Yeah, I mean, it's never fun to see your portfolio shrink, that's for sure.
Definitely not. But, before anyone out there hits the panic button, we're going to take a deep dive into why this is happening and, more importantly, what you can do about it.
Absolutely. I think the key here is understanding that market swings, they're just a normal part of the cycle, especially after a stretch of relative calm like we've had recently.
Right, right. So for this deep dive, we're looking at this interesting guide we found. It's called OGO, which translates to a guide to investing in a volatile stock market.
Oh, interesting.
Yeah, it really dives into like the current anxieties in the market, but also offers some historical perspective, which I think you'll find helpful.
Yeah, I think a lot of the anxiety right now, it really stems from just uncertainty, particularly around President Trump's trade policies.
Yeah, that makes sense.
The guide, it highlights how these tariffs and just the ongoing trade tensions in general, they're creating a lot of unknowns for businesses, and for investors.
So basically, Wall Street just hates not knowing what's going to happen next.
Exactly. Uncertainty, it just spooks the market. With tariffs, it's particularly tricky because they can have this ripple effect through the whole economy.
I do that.
It's not just about the direct cost of the tariffs themselves, but you have to think about potential disruptions to supply chains, and the impact on global trade overall.
Right, right. And I imagine trying to predict how long these tariffs are going to last or like how this whole thing's going to play out, that's got to be nearly impossible.
It really is, yeah. And that lack of predictability, that's what fuels this volatility we're seeing. Investors are essentially just reacting to the unknown. And when fear takes over, well, we tend to see those knee-jerk reactions, that can kind of send the market spiraling downwards.
Yeah, I see what you mean. So it sounds like understanding the psychology behind these market movements, that's just as important as understanding like the economic fundamentals, right?
Absolutely. The guide, it really emphasizes how much market sentiment plays a role in how prices actually move. Sometimes just the perception of risk can be just as impactful as the actual risk itself.
Wow, that's really fascinating. So even if like the underlying economy is relatively strong, if there's a perceived threat out there, that can still trigger a downturn.
Precisely. And honestly, we've seen this play out again and again throughout history. The market doesn't always react rationally. That's just something investors have to be aware of.
Okay, so we've established that volatility is like this inherent part of the market.
Yeah.
But what about those really big drops?
Mhm.
The ones that make headlines and have everyone hitting the panic button. What does our guide say about those?
Well, it points out that drops of, say, 10% or more in the S&P 500, they're actually not as uncommon as you might think.
Oh, really?
Yeah, they happen almost every year.
Wow, I guess I hadn't really realized it was that frequent. But wouldn't that suggest that maybe these dips are actually a normal part of a healthy market?
They can be, yeah. It's helpful to think of it like a pressure valve almost.
A pressure valve. Okay, I like that.
Yeah, these periodic dips, they can help to prevent stock prices from getting too inflated. They're like a correction mechanism, bringing valuations back in line with reality.
Okay, that's a helpful way to look at it.
Mhm.
So instead of freaking out when we see a dip, maybe we should be thinking of it more as a natural, course correction.
Exactly. And the guide reminds us that historically the S&P 500, it's always bounced back from these downturns. I mean, even after major events like the Great Depression, the dot-com bust, the 2020 crash, it always recovers.
Wow, yeah, when you put it that way, it really puts things into perspective.
It does, yeah. And it underscores how important patience is when it comes to investing. The guide, it recommends only investing what you can afford to lose for several years, ideally up to 10. It's a long game, not a get-rich-quick scheme.
That's a good point. It's easy to get caught up in those short-term fluctuations, but ultimately, investing is about long-term growth.
Exactly. And that brings us to, the big question a lot of investors are probably grappling with right now. Should you sell everything and run when the market takes a dip?
Yeah, that's the million-dollar question, isn't it? Especially when you see your hard-earned money seemingly disappearing. What's the guide's take on this?
It strongly advises against panic selling.
Okay, but what about protecting your assets? Wouldn't selling at least help minimize those losses?
That's a common misconception. The problem is when you sell when the market's down, you're locking in those losses.
Right.
And even more importantly, you miss out on the potential gains when the market inevitably recovers.
Right, right. So basically trying to time the market perfectly, that's virtually impossible, even for like seasoned investors.
It really is. And even if you did manage to sell at a good time, there's no guarantee you'll be able to buy back in at a lower price, right? You could end up missing the rebound altogether.
Yeah, that's definitely a risk I wouldn't want to take.
Yeah,
But I get it. It's hard to fight that urge to protect yourself when things feel shaky.
I understand. And that's exactly why it's so important to have a solid investment strategy in place before you even start investing. A strategy that you can trust and you can stick to even when things get turbulent.
Right. What about all those gains we saw recently, though? The guide mentioned those back-to-back 20% gains in the S&P 500. We haven't seen that since before 2000. Wouldn't that make these dips feel even more jarring?
It can, yeah. Especially for newer investors who haven't experienced a full market cycle yet. But it's important to remember those gains they were part of, like an unusually long bull market.
So what we're seeing now is kind of a natural correction after this extended period of growth.
Exactly. And that's why it's crucial to have a long-term perspective. The market's always going to go through periods of growth and contraction. That's just its nature.
Okay, so we've established that volatility is normal, panic selling is a no-no, and patience is key. But what about this idea that even during these overall dips, some areas perform better than others? The guide mentioned this, talking about the Magnificent Seven and international stocks.
Oh, that's a great point. And it brings us to one of the most powerful tools in an investor's arsenal: diversification.
Diversification, yeah, I've heard that term thrown around a lot. But what does that actually look like, in practice?
Well, it's all about spreading your investments across different sectors, different asset classes, even geographic regions. The idea is to reduce your exposure to any single area of the market.
So instead of putting all your eggs in one basket, you're creating like a safety net.
Exactly. And the guide points out that, with the recent dominance of big tech, some investors might actually have portfolios that are less diversified than they realize.
So anyone who's been riding the tech wave, they might be a little more vulnerable to these market dips.
They could be, yeah. And that's why it's so important to reassess your portfolio and just make sure you're not overly concentrated in any one area.
This is all starting to make a lot more sense now.
Yeah.
Diversification isn't just a buzzword. It's like this fundamental principle of smart investing, especially in a volatile market.
Absolutely. And we'll actually delve deeper into the specifics of diversification in part 2, exploring how to build a resilient portfolio that can really weather those storms.
All right, welcome back. I got to say, I'm feeling a lot less stressed about market volatility and a lot more empowered to actually do something about it.
That's great to hear.
Especially after that talk about diversification part 1.
Yeah, diversification, it's like your secret weapon when it comes to riding out those market swings.
Okay, so in part 1, we talked about how spreading your investments across different areas, that's key. But how do we actually put that into action? Where should we be looking beyond those big tech names?
Well, you know how the guide mentioned that companies outside the Magnificent Seven have actually been doing pretty well. That's a good place to start, Instead of assuming tech is the only path to growth, think about exploring sectors that might be a little overlooked.
Okay, so which sectors are we talking about? Give us some examples.
Well, healthcare, for one. As the global population ages, the demand for healthcare services and innovations in healthcare, that's only going to increase.
Makes sense.
It's a sector with huge long-term growth potential, and it's not as tied to, the whims of the tech industry.
Right. What else is out there?
Renewable energy is another area to consider.
Oh, yeah, that's a hot topic these days.
It is. With all the focus on sustainability and the shift away from fossil fuels, companies in this sector, they're poised for some serious growth.
So solar, wind, that kind of stuff.
Exactly. And it's not just about the environmental benefits. Investing in renewable energy, it can be a smart financial move too, as these technologies become more and more competitive.
Yeah, I can see that. Okay, healthcare, renewable energy, any other sectors worth checking out?
Well, the guide also mentioned international stocks as performing well recently. Emerging markets in particular can offer some, exciting opportunities.
Emerging markets? That sounds a little riskier though, doesn't it?
There's always risk involved with investing, but emerging markets, they can offer higher potential returns too. Think about countries in Asia, Africa, Latin America, places that are experiencing rapid economic development.
Good, yeah.
As those economies grow, the value of companies operating in those regions, it grows too.
It's all about finding that balance between risk and reward, isn't it?
It is. And that's exactly where diversification comes in. By spreading your investments across these different sectors, including some exposure to emerging markets, you're helping to mitigate that risk.
Okay, so we've got sectors covered.
Right.
But diversification, it's more than just stocks, right? What about those other asset classes you mentioned?
Right. Stocks are just one piece of the puzzle. A truly well-diversified portfolio, it also includes things like bonds, real estate, even commodities.
Okay, let's break those down a bit. Bonds, I know those are considered less risky than stocks generally.
Yeah, they are. Bonds are essentially loans that you're making to governments or corporations. They tend to be less volatile than stocks, and they can give you a steady stream of income through those interest payments.
So they're a good way to kind of balance out the potential ups and downs of the stock market.
Exactly. Then you've got real estate, which can offer both appreciation potential and rental income. It's a tangible asset, which can be appealing to some investors.
Okay, yeah. What about commodities? Those are things like oil and gold, right?
Right. Commodities can be a bit more volatile, but they can also provide a hedge against inflation. So, when the cost of living goes up, the price of gold often rises too.
So having a little bit of gold in your portfolio could help protect your purchasing power over time.
That's the idea. Now, it's important to note that building a diversified portfolio, there's no one-size-fits-all approach,
Okay, yeah, makes sense.
The specific mix of assets that's right for you, it depends on your individual circumstances, your risk tolerance, and of course your investment goals.
So no two portfolios are going to look exactly the same.
Not at all. And that's why it's so important to have a clear investment strategy. Do you want to be more hands-on, picking individual stocks and bonds? Or do you prefer a more passive approach using things like index funds or exchange-traded funds, ETFs?
I've heard those terms, index funds and ETFs, but could you remind me how those work again?
Of course. Index funds, they track a specific market index, like the S&P 500. So by investing in an index fund, you're essentially buying a small piece of all the companies in that index.
Okay.
It's instant diversification.
So it's an easy way to get exposure to a wide range of stocks without having to pick and choose individual companies.
Exactly. And ETFs, they're similar to index funds, but they trade on stock exchanges just like regular stocks. They offer a really convenient way to invest in specific sectors or asset classes or even investment strategies.
So if I wanted to invest specifically in renewable energy,
Mm-hmm.
I could find an ETF that focuses on that sector.
You got it. EPFs give you a lot of flexibility. They can be a great tool for building that diversified portfolio. Now, whether you choose individual stocks, bonds, mutual funds, ETFs, the key is to do your research, understand the risks involved, and create a plan that aligns with your goals.
And remember, you don't have to go it alone. There are tons of resources out there, from books and websites to, financial advisors.
Absolutely. A financial advisor can be super helpful. They can help you assess your risk tolerance, determine your investment goals, and create a personalized plan that's tailored to your needs.
Okay, so diversification is about spreading your investments across different sectors, asset classes, even geographic regions. We've got some specific ideas now, which is great, but what else can we do to kind of navigate these market dips? Anything else in our Korean guide that might be helpful?
Well, the guide really emphasizes how important it is to stay informed and to understand the factors that are actually driving these market movements.
So knowledge is power, in this case. But there's so much financial news out there, it's easy to get overwhelmed. Where should we be looking for, reliable information?
You're right, not all sources are created equal. I'd say look for reputable financial publications, websites, or even podcasts like this one, of course, that present information in a clear, unbiased way.
So basically, do your research, find sources you trust, and try to avoid getting caught up in all the hype or the fear-mongering that can sometimes dominate the news cycle.
Exactly. It's about staying informed without letting all that noise dictate your investment decisions. Remember, the market, it's driven by both emotions and fundamentals. And when fear takes over, that's when people make impulsive moves they often regret later.
Which brings us back to that importance of patience, right? We talked about how the market has always recovered from those downturns. Sticking to your strategy and riding out the waves seems like the best approach.
It is. Think of it like a roller coaster. There will be ups and downs, twists and turns, but if you stay buckled in and keep your eyes on the horizon, you'll get to the end of the ride.
And hopefully with some nice profits along the way.
Exactly. Now, let's shift gears a bit and talk about a group of investors who might be feeling particularly anxious right now. Retirees.
Right. It's got to be stressful when you're relying on your investments for income and then the market takes a dip. What does the guide suggest for people in that situation?
It emphasizes having a solid plan in place for withdrawals during those market downturns.
So don't just start taking out huge chunks of your savings when the market's down.
Exactly. Taking large withdrawals when your portfolio has shrunk, that can really deplete your nest egg and put your long-term financial security at risk.
Yeah, that makes sense.
Yeah.
But I imagine it's a tough conversation to have, realizing you might need to tighten your belt a bit or delay certain plans when the market isn't cooperating.
It can be, yeah.
Yeah.
But remember, it's all about finding that balance between enjoying your retirement years and making sure you're financially secure for the long haul.
So having a financial advisor to kind of guide you through those decisions could be super helpful.
Absolutely. A good advisor can help you create a withdrawal strategy that minimizes the impact of market volatility and helps ensure that your money lasts throughout your retirement.
Okay, so we've talked about diversification, staying informed, being patient, and some specific advice for retirees. But I can't shake this one big question that I know everyone keeps asking.
How long will this downturn last?
Yeah, exactly. I know we can't predict the future, but are there any, clues, any indicators that can help us make sense of all this uncertainty? Anything we can look at to kind of get a sense of where things might be headed?
I mean, there are always experts out there making predictions, but honestly, the market is so complex and it's influenced by so many factors that it's impossible to predict with certainty.
So trying to time the market, that's basically a fool's errand.
Pretty much. It's
Oh,
like
no.
trying to catch a falling knife, You're more likely to get hurt than to actually succeed.
Okay, no market timing. Got it. But what about tools or strategies that can help us navigate this uncertainty? I'm thinking of things like stop-loss orders and dollar cost averaging. Are those useful in a volatile market?
These are excellent questions, and ones that honestly deserve a deeper dive of their own.
Ooh, I'm intrigued. Guess we'll save those for part 3 then.
We will. But for now, let's wrap up part 2 with a key takeaway. While we can't control the market's ups and downs, we can control our reactions to them.
That's a good point.
By focusing on what we can control, our investment strategy, our diversification, and our long-term perspective, we can navigate whatever comes our way.
I love that. We're not just helpless passengers on this roller coaster. We can actually take control and kind of steer ourselves in the right direction. Well, that's a wrap on part 2 of our deep dive into market volatility. In part 3, we'll explore those tactical strategies you mentioned, like stop-loss orders and dollar cost averaging, and see how they can help us ride this roller coaster with a little more confidence. Welcome back to the deep dive. We've covered a lot of ground on market volatility, but I'm ready to get into some tactical strategies. In part 2, we teased stop-loss orders and dollar cost averaging. I'm really curious to hear more about those.
Yeah, happy to unpack those a bit. They can definitely be useful tools. But it's important to understand, how they work and what the potential downsides are, especially in a volatile market like we're seeing now.
Okay, let's start with stop-loss orders. Those are designed to automatically sell a stock if it drops below a certain price, right?
Right.
Seems like a pretty good way to protect yourself from those really big losses.
Yeah, that's the idea. You're essentially setting a floor like, okay, this is how much I'm willing to lose on this particular investment, but there is a catch?
I figure there had to be. What's the downside?
Okay, so imagine this. The market takes a sudden, sharp dip, right? Triggers your stop loss and your stock gets sold. But then, just as quickly, the market rebounds. What happens?
You're out of the game, sitting on the sidelines while the stock recovers. You miss out on all the potential gains.
Exactly. And in a volatile market, those kinds of sudden swings are more common. You could end up selling at a low point only to see the stock climb right back up without you.
So stop-loss orders aren't like a foolproof safety net.
Not really, no. They can provide some peace of mind, but they also come with that risk of getting you out of the market at the wrong time. That's a bit of a gamble, honestly.
So how do you use them effectively then?
I think it's about finding that right balance, Setting your stop loss at a level that makes sense for your own personal risk tolerance. Don't set it too tight, or you'll risk getting shaken out by just normal market fluctuations. And remember, stop loss orders are just one tool in your toolkit.
Okay, that makes sense. All right, let's move on to dollar cost averaging. Remind me how that one works again.
Sure. So with dollar cost averaging, you're investing a fixed amount of money at regular intervals, no matter what the market price is. Say you decide to invest $500 every month, regardless of what the market's doing.
So you're consistently buying, even when the market's down. I can see how that could help take the emotion out of investing, especially when things get a little scary.
Yeah, that's one of the big benefits. By investing consistently, you're basically averaging out your purchase price over time. When the market dips, you're buying more shares at a lower price. And when the market rises, you're buying fewer shares at a higher price.
It just feels more like rational and less reactive than trying to time the market perfectly, which we already established is basically impossible.
Exactly. And it can be a really effective strategy in a volatile market, specifically because it helps you smooth out those ups and downs. You're not trying to guess where the market's headed, you're just sticking to your plan.
Okay, so dollar cost averaging, another good tool for our investor toolkit. But I know you're going to tell me there's no magic bullet in investing, really.
Right. Unfortunately, no. Neither stop-loss orders nor dollar-cost averaging can guarantee profits. Investing always involves some level of risk.
So what's the main takeaway here?
The key is to really understand how these tools work, weigh the potential benefits and risks, and then decide if they actually fit with your investment strategy and your own personal risk tolerance. There's no one-size-fits-all approach.
And remember, folks, this is just a taste of the strategies that are out there. There's a whole world of investing knowledge to explore. Do your research, talk to a financial advisor if you need to, and just keep learning.
Couldn't agree more. The more knowledge you have, the better equipped you'll be to make those informed decisions.
Well, that brings us to the end of our deep dive into navigating market volatility. Any final words of wisdom you want to leave our listeners with?
Just remember that market volatility, it's a natural part of the investing journey. Don't let it derail you from your long-term goals. Embrace the ups and downs, stay informed, and most importantly, stay focused on your personal investment strategy.
That's great advice. I think we've all learned a lot today. I know I feel a lot more prepared to handle whatever the market throws my way. Thanks for joining us on this deep dive. And remember, the best investment you can make is in yourself and your knowledge. Keep learning, keep growing, and keep exploring that fascinating world of investing.